Welcome to the Canadian Investors Course Session 5, the economics that move various investment assets. Please note again slide 2, terms of use and disclaimer. The authors of these videos and articles cannot assume any responsibility for what any viewer or reader might choose to do with this educational information. From time to time, the authors may express certain opinions in these videos or articles. An opinion is an interpretation of the facts at hand. The author of this video or article may or may not hold positions in the financial instruments discussed. This is not how you do financial planning. I retire on Friday and I haven't saved a dime. Here's your chance to become a legend. No, we'll talk about financial planning a little later on. This isn't how you do it. By the way, also, here's another thing this is not. It's not an economics course. But what we are interested in how economics affect investments. So here, what we're going to do is point out to you some of the important things to pay attention to and when they happen to be wary of. So things to look out for, which as an investor, are what the Federal Reserve is saying, what's happening to interest rates, and more importantly to the yield curve. What direction are currencies going? And where are you in the economic cycle? We'll give you some indicators, some real indicators as we go through this session. First of all, what can the government do? Well, the government controls fiscal and monetary policy. So fiscal policy involves the government changing tax rates and levels of government spending to influence the demand on the economy. Monetary policy involves changing short-term interest rates and influencing money supply. So, fiscal policy. What can elected politicians do? Well, when they play with taxes, they'll either stimulate the economy in general or they'll stimulate certain sections of the economy. So, for example, if they change the tax rates on certain industries or products, it will increase or it will either stimulate them or slow them down. And if they change taxes on investments, if they lower taxes, it'll lower the capital gains tax. It might stimulate investment in stocks or real estate or wherever the tax rates were adjusted. They can create deficits in bad times. In other words, spend more to stimulate the economy, and hopefully trim their spending as the economy starts to improve. This is called Keynesian economics, and it's a nice thing in theory, but in practice, politicians nowadays seem to like to spend more than they like to save. And then there are automatic stabilizers in the program. For example, unemployment insurance, which automatically goes up when jobs are lost, and vice versa. Okay, what about monetary policy? Well, these are actions performed by the central bank. So these are sort of control tools that are handled by supposed experts. So example of central banks are the Bank of Canada, the U.S. Federal Reserve, and the ECB, European Central Bank. Policy is based on microeconomic activity, and it's used to promote economic growth, job growth, and to adjust inflation. Central banks can expand or contract the money supply depending on what their objectives are at the time. They can determine short-term interest rates. And they can practice quantitative easing, which is a recently created idea, where they can buy back bonds with money, and it helps the government because when the government issues bonds, if the market doesn't want to buy them, they soak them up, and it keeps rates low. The central bank can also respond to economic data. They can stimulate in reaction to poor data. The stocks tend to do well when the Fed is not threatening to raise interest rates. Obviously, the opposite occurs as well. And real estate sales do well when interest rates are low or they're falling. Interest-sensitive investments do well when economic data is weak and interest rates are falling because they tend to pay dividends, and people like that, especially when the markets look questionable. And of course, if the Fed can keep inflation low, they can keep interest rates low, which keeps the stimulation going. Quantitative easing and money supply growth promote economic activity versus the opposite, which is tightening. Now, what about the yield curve? The yield curve, as we explained in segment 2, is a set of data that reflects interest rates at all maturity levels. And since 1950, with the exception of one instance, an inverted yield curve has always been a precursor of every recession. So it's a very reliable recession indicator. And an inverted yield curve, as you'll remember if you followed session 2, is where short-term interest rates are lower than long-term interest rates. And usually the period in question is the 2 to 10-year rates. So inverted yield curves occur when the central bank raises short-term rates and causes bond investors to buy long bonds in anticipation of a slower economy. A slower economy usually brings lower inflation, which is attractive to longer-term bondholders. Sometimes the Fed overdoes it, and it triggers a recession. So another interesting thing to remember is that when you get an inverted yield curve, that's when you want to buy interest-sensitive investments. Best time. And by the way, there is a link here that you can follow if you'd like to look at the U.S. Treasury yield curve. Notice the correlation between yield curves and recessions. You can see when the blue line goes to 0 or below, the yield curve is inverted, and when the gray shaded areas show the recessions that soon followed. So inverted yield curve, recession, inverted yield curve, recession, inverted yield curve, recession, and so forth. So, what about today, where we've got these very low interest rates, essentially negative yields? Well, the gap between the 2 and 10-year treasuries as a measure of yield curve fell about 75.5 basis points in 2016, flattest since November 2007. So in other words, we're living in a very flat yield curve environment. And eventually, as the Fed starts to tighten, as it seems to be doing at the beginning of 2018 right now, it won't take much to create an inverted yield curve. So maybe we better be paying attention to that. Now, central banks and currency rates are something else you have to follow. Currency manipulation can occur when countries sell their own currencies in foreign exchange markets, usually against the US dollar, to keep their exchange rates weak. This has been happening forever between Japan and the United States, and it's happening right now with China and the United States. So, I'm not going to delve into the complexity of this chart, but you can look at it at your leisure. You can see, however, what happens at the different points of the economic cycle. If you start at the recovery phase, just because that's where it starts on the page, obviously the Fed or the central bank is going to try and stimulate the economy, so they're going to have short-term rates will probably be falling. They'll cut them. Bond yields will be bottoming, and the stock market will start to pick up. It's sort of like the spring when the flowers start to pop out. And of course, the early upswing phase, there's an increase in confidence. Short-term rates continue to be soft to neutral. Bonds are stable, and of course, the stock market's probably doing well. People are getting more optimistic. Then in the late upswing stage, there's a boom mentality. People are willing to speculate. Short-term rates start to rise, but the markets may even ignore them. But finally, you roll over and it starts to head back down again. The economy slows, perhaps enters a recession. Confidence drops suddenly. Market the short-term rates peak, and you may fall into recession where confidence becomes weaker and short-term rates start to drop, and then the cycle starts again. And that's the important thing to remember. These are called cycles because they do what they do and then they start again. This slide here describes which sectors tend to do better at different parts of the economic cycle. Let's not dwell too much on it. Let's go to this one. Now, if we could start anywhere on the page, where'd be a good place to start right now in February 2018? Well, why not just start in the top left-hand corner? Monetary indicator. Short-term rates are rising. Long-term rates rise. Fed tightens. What's happening? We've just got a rise in the Fed funds rate. It looks the news is telling us they might go up 4 times this year. Interesting. So, what economic indicators are there? Does this confirm that we're in the right quadrant? Well, leading indicators are beginning to point down. Certainly, there's volatility in the stock market. Capacity utilization is high. Wages increase. We just had an increase in minimum wage. And manufacturing levels are high. It seems to be the case. What about sentiment? Is inflation a worry? It certainly is today. And lots of warnings that it's a boom. And of course, there's lots of optimism and consumer confidence. So this confirms that we're probably right now in the late cycle, a cycle of decreasing growth. And in fact, depending what happens to the yield curve, as we've just said, we may in fact fall into recession. But the good news is that when we fall into recession, unless the economic cycle pattern is broken, the next step will be an early recovery, and finally moving back to mid-cycle and then to late cycle again. So this is a cycle, and the important thing is to participate appropriately with your investments so you take advantage of the cycles rather than being hurt by them. That's the end of the commentary. That's the end of session 5, the actual fundamental course. I encourage you to look at the commentary if you'd like to know a little bit more about this subject.